Good morning from our world headquarters in New York. I'm Manus Cranny. Danny Berger in Berlin today, where she's speaking to the BlackRock CEO Larry Fink. Welcome to Bloomberg Brief. Let's set the agenda. The clock ticks down closer to the deadline. A U.S. shutdown appears all but inevitable. Kevin McCarthy continues to struggle to get the hardline Republicans on board. The demand comes clear from UAW. Auto workers want at least a 30% pay rise from Ford, GM and Stellantis. The prospect of a resolution may help investor sentiment. And the BOJ announces an unscheduled bond buying operation after yields cross the curve, climb to decade highs. Let's begin with the breaking news. We're on inflation watch globally, but to Europe first of all. The euro area inflation is crossing the wire. Maria has the numbers. Maria, take it away.
Yes, Manus, and look, what we see is a significant drop in inflation in the euro area in September, both on a headline basis, but also the core number. This is the number, Manus, that really matters. Euro area core inflation in September now is at 4.5% on a year-on-year basis. So you see now that both are in the 4% handle. Now, Manus, overall, what this means is that the European Central Bank and the market is very well positioned for this. Now has a case to say, maybe let's take a breather and pause. Remember, the market does believe that there won't be more hikes. It is a question of higher for longer. If you look at the data here, both on a core but also on a headline basis, you see a significant drop in inflation in September, now 4% handle, but also that core number that is very significant. It does show that this monetary policy is really feeding into now the real economy.
And will that kick in to peak ECB as the differential between them and the Fed is what's driving the ultimate alpha of the dollar and the drop on the euro. Euro dollar at the moment is trading at 106.05. So you have this particular non-reaction. A lot of it is already in the price. The presumption of a rollover in inflation down 2% on the month, down 3.2% over the past 2 months. We'll track the euro dollar through the morning. But there's almost like a cessation of violence across the assets as we go to the quarter end and the month end. It's as if there's a sense of exhaustion in equities and bond markets to a certain extent. The S&P has had its worst month of 2023, down 5%. So we pause for thought on the equities this morning. It's almost as if the Fed speak from Goolsbee, where he talks about, look, you risk a policy error if you keep looking at historical data and historical models, and to that extent you could have a policy error. Consumer spending was a lot weaker, the weakest that we've seen in a year. The price index from the consumer component was also the lowest that we've seen since 2021, setting us up perhaps for a more bullish PC deflator today, which could help take some of the steam out of this hiking narrative. Don't forget, middle of the week, we were talking about 7% on rates. So futures are just bouncing a little bit this morning on the equity side. Europe up by 0.7%. When you roll it over and you look at the assets, you have, again, this sense of exhaustion coming to bear. Mini intervention from the Japanese. I think this is significant. This is a message not only to the bond market, as we saw the longer end of the Japanese curve make decade highs. The Japanese come in today and they say, no, enough. We're going to jump in here. They're using the flexibility of yield curve control. It was small, but I would say it's significant in its indications. So you've got 10-year government bond yields just below the 0.77% where they jumped in. The dollar index drops ever so slightly. Again, this goes back to the view, has your run been done? The wind came out of the market yesterday on the consumer numbers, and the 30-year yield, I popped it in there. I mean, this is up the biggest quarterly jump since 2009. We are now in the fear stage for the bond market because you've yet to see some kind of doom loop of massive selling of bonds to perhaps de-risk and take losses. So there are many unrealized losses out there. Bill Ackman is saying that he wouldn't be surprised if you saw the longer end of the curve get to 5%. So that's the state of play on risk. As I say, there is that sense of exhaustion across these markets. And with that in mind, we go to the end of the quarter. Danny Berger is in Berlin, and she's had the pleasure of getting together with Larry Fink. Danny, top takeaway. Good morning.
Good morning, Manus. It's so interesting to hear you talk about fear in this market, because my top takeaway from Larry Fink was that fear would be the thing that caused an American recession. He was very critical of global leadership in that regard, saying that he meets with politicians all the time, and he says they need to have more hope, to which I said, So Larry, for president then, and to which he remarked, Danny, I am too young to be president, which was absolutely the best line of the conversation. But I want to get more into it, some of the details of what he said about rates and about the economy. So here's some of my conversation with BlackRock chairman and CEO Larry Fink earlier at the Berlin Global Dialogue Forum.
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to the inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics. Is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is at what cost? And nobody answers that question, at what cost?
Well, there are a lot of calls of a recession, hard landing, soft landing, no landing. They've all lost their meaning at this point. Let's be honest. So in this era of fear, of no hope, are we headed for
there's not
right
no
now?
hope. It's all, I'm hopeful.
Let's hope. Larry's hopeful. We're happy about that. But does that mean we are headed for a recession right now?
So I think we have to analyze that by each region, because the United States, our home mortgage market is based on a 30-year mortgage. So anybody who has a home mortgage, higher interest rates does not impact them. And so the transmission of high elevated interest rates in the U.S. takes much longer to impact the economy. Whereas in other places where you have more floating rate, or like in the United Kingdom where you have generally a 5-year fixed and then it resets. And so let's assume 20% of the mortgages have to be, reevaluated at a higher level. That creates more immediacy at higher rates. So I think we're going to see some economies enter recessions early.
Which ones would that be?
Well, I think Europe.
Is anyone's more sensitive to
the ones that are more sensitive to this elevated interest rates, and you're starting to see a real decline in GDP and other. They're basically flat now, but can they go into a more protracted recession? Whatever the recessions we're going to have, they're going to be quite modest. So I'm not even that fearful. But the other issue.
I have a stat for
let me just say one thing,
yes,
Danny.
Yes, then I'll inject the fear.
Okay, but I believe if we have labor shortages, if we're getting back to this whole social issue of how are we going to be doing this, in many areas you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, and as I said, the J-curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025 the United States economy may be entering a recession, but I don't see it any time in the near term.
So it might be a few years, but there still might be a recession. That was BlackRock chairman and CEO Larry Fink. Manus, our interview on that, the write-up of it, it goes more into BlackRock's hunger for more deals. That's one of the most read stories on the terminal this hour, and we'll, of course, have more of his comments ahead, Manus.
Don't worry, I'm tracking you most read. You got plenty of headlines out of there. It's interesting that he talks about the structure of the UK market and their mortgage market versus the structure of the mortgage market here, and that is perhaps the saving grace here. You're all on 30-year mortgages here, and there's a lot of people never moving out. But good, you got the 5% call, above 5% on the 10 years. It's been a hell of a month for the bond market, moving by 50 basis points. Well done, Danny. It looked like an enjoyable conversation. We'll get more of it in just a moment. Let's just talk about some of the other stories that we're tracking this Friday morning. We got there. We didn't break anything. Well, at least not yet. The House Republicans, they released the text of a GOP leadership-backed stopgap bill. That would fund the government for a month while making cuts to some non-defense domestic spending programs. Prospects for legislation, well, that's uncertain. And far from suburban Detroit, a less splashy labor fight is unfolding. Unions in Arizona are negotiating with the world's biggest chipmaker, TSMC, on the resolution of labor issues that have dogged TSMC's Phoenix construction site, a flagship project of President Biden's effort to make more critical electronic components right here in the US. And then there's the Bank of Japan, as I mentioned at the top of the show, the unscheduled bond buying operation. A reminder to the market, there's a determination to manage the upward momentum in sovereign yields. It's called flexibility, flexing the muscle of YCC. Let's see what Jane Foley makes of all of that. She is our guest a little bit later on. She is the head of FX over at Rabobank. Jane Foley on Bloomberg. And we've got a CEO, another one for you. Roy Jakobs joins the Bloomberg Brief later this hour, right here on Bloomberg. This is Bloomberg Brief. I'm Menace Crenny in New York. Danny Berger reporting from Berlin today, where she sat down with Larry Fink. More of that in just a moment. So, today was the day when the Bank of Japan went back into the market. This is yield curve control flexibility. It wasn't huge. It wasn't a monster move by the Bank of Japan, but they did come in and they intervened. They bought 300 billion yen. $2 billion of 5- and 10-year paper. Let's see what the FX world makes of that message to the rates market. Jane Foley watched the action and has, I'm sure, an opinion. I take this as a warning sign, not just to the rates market. I take it as a warning sign to the FX market as well. How do you extrapolate the mini intervention this morning showing the flex of YCC? Ms. Foley, good morning.
Good morning to you, Manus. Well, timing is everything, isn't it? And it's interesting that they chose today to exercise a little bit of the flexibility of yield curve control on the day when US Treasury yields are relenting a little bit down off their highs. I mean, to be honest, if they had tried to repress JGB yields just a couple of days ago, well, I think the market would be even more worried about the prospects for dollar yen, heading higher. So I think the timing was right today to do that. We've got to remember, we also had some Japanese economic data out this morning, quite a lot of it. We had some CPI numbers, we had retail sales, we had industrial production too. And what the CPI showed us, particularly the core measure, is that inflation pressures are coming low. And we've got to remember that the official forecast for CPI inflation in Japan is for it to come way back below that 3% level next year, around about 2.5%.
Well, Jane, they get a bit of a relief from the inflation story. They get a relief, I mean, even Europe inflation coming down too. But when you look at the relenting march in bond yields higher, at what point are they going to get a true test? That means that they can no longer have YCC, that it's unsustainable and just becomes too costly to defend the targets.
Well, we've got to look at dollar yen, for that. And we know already that there is a lot of discomfort. 150, 155, certainly there will be a huge amount of discomfort, because we've got to remember it's not necessarily for Japan's biggest companies. The Toyotas, they're all very outwardly facing. They can export into this. They can perhaps benefit to some degree from the cheaper yen. But it's those companies that are the smaller companies that have to import in their raw materials and sell domestically. They're the ones that have really been suffering from this weaker yen, and the economy is not strong. So there is a point where the weakness of the yen makes things a lot worse for the domestic economy, for the growth outlook for certain sectors of the economy. And I think we're hitting the point where politically it's going to be quite difficult for the Bank of Japan to keep on defending its policies at this point.
Jane, we're going to spend more time on the shutdown. We've got the shutdown clock. We are counting down. It looks like there is no resolution or a lack of resolution at this juncture. Now, the FX world is divided. I've got Kit Jukes making it very clear that a shutdown would be injurious to the dollar. The prolonged US shutdown would bring the dollar closer to its peak because basically, risk aversion would be brief. In other words, the bid that you say we will get for the dollar will be brief. How do you respond to that?
I think this is all related to timing. Now, I think one thing's very clear. If this was happening in any other country, we would see a big sell-off in the currency. I think we all can understand that. But the dollar dynamics are somewhat different. And this is really related to the fact that the dollar is the very, very dominant currency on the global payment system. And so what you tend to see is that when there is any degree of crisis, almost irrespective of the cause, even if the cause is the US itself, that you see people wanting more dollars in order to pay those invoices or to pay the dollar denominated debt. And so that's, really where the safe haven bid comes from. And I think for at least if we have a very short shutdown, the market will appear to be looking through this because we don't tend to have these big reactions, negative reactions on the dollar to negative US fundamental news. So I think for now we can hold steady.
To that point then, what derails the dollar's rally, Jane? What do you see credibly that could turn this around? I mean, it's lower this morning, but what then, if anything, could derail the rally?
Well, generally, when we have people moving away from the dollar for a prolonged period, it's generally because they see opportunity in other currencies. So generally, it's when we have high risk, a risk-on environment. But the problem is right now is that, you might have, a slowdown in the US. We certainly think there could be a mild recession in the US, evident early next year. And yet, what are you going to sell? Because are you going to buy, China? Are you going to buy euro? And this is the problem. So even if you have a slowdown in the US, it's quite likely, I think, that the dollar will remain pretty well supported until you have risk appetite building. And probably to trigger that, you will need a real feel that the Fed interest rate cut is around the corner. And of course, the market has been pushing those expectations back recently.
Well, let's see what the PCE deflator is today. A lot of people are sort of saying, if you look at the consumer data yesterday, it perhaps sets us up for that slightly better narrative. Let's turn back to our top breaking news story at the top of the hour, which was core inflation in the Eurozone hits a one-year low. Does that reinforce a pause? I mean, I looked at the euro before I came on here, down 2% in this month. It has had that bruising stagflation hangover, and here we are. Core inflation hits a one-year low. What does that do to the euro? It's hardly flinched at the moment, so I just wonder, is that rollover in inflation all in the price? Jane?
Well, I do think that we're going through a little bit of a pause. We're back above 106. We've seen equities a little bit higher. So we're having a little bit of a breather right now, and that could extend maybe for another couple of days, maybe not, because I do think the fundamentals for the Eurozone are not quite in that price yet. We had a recession already for Germany last winter. We've got stagnation now. We've probably got, in our view, a stagnation for the whole of the Eurozone in the second half of this year. So we've got some real strong growth headwinds, facing the Eurozone. And I think that is a situation which could really drag on the euro for a prolonged period.
Okay, Jane, thank you very much. Giving us her view on the FX markets live and real. Jay Foley over at Rabobank. I want to give you a quick snapshot of what's going on in the bond markets, because you are just seeing these yields roll down across the market. In Germany, core inflation is at not Germany, in the Eurozone at a one-year low. But you saw such a monster move yesterday. The yields on 10-year paper rose by 20 basis points to 4.56%. So you are just seeing, as Jane says, there's momentary pause in some of the, I suppose, vertiginous moves that you've seen in these bond yields. Check them out. They are relevant as we go to the quarter end and the month end. It's been vicious and brutal, and the vigilantes have not only had breakfast, dinner, and supper. Good morning from New York. This is Bloomberg.
This is Bloomberg Brief. I'm Danny Berger reporting from Berlin today. Manus Cranny, as always, is in New York. Manus, let's talk banks, because Credit Suisse says it may incur losses of $2.2 billion in the third quarter as it exits more businesses following its acquisition by UBS, Manus.
Yep, that ongoing transformation and marriage of great inconvenience rolls on. Elsewhere, we've got the Saudi Arabia pending a deal with the PGA Tour, maybe scuppered by Henry Kravis, Endeavour Group and Fenway Sports Group. The American investors are exploring potential investments in the golf franchise. For more on the story, let's get to Joe Easton. He's in London. Joe, does this threaten the PIF's attempted merger? Would they supplant the PIF? What's the top line?
I think it could threaten the deal, given that there was a lot of backlash against the Saudi merger, even among players, largely due to the political aspect, with a lot of even politicians in the US speaking out over it. The backlash wasn't like we saw in the UK, with the Saudis investing in football here. People kind of accepted that. In the US, it didn't, so I think it is a threat to that deal.
Joe, just because we're all among friends here and the many viewers of Bloomberg TV, I got to be honest, I don't watch golf. So you need to explain this to me. Only a minute here, Joe, but why all this attraction to golf right now?
She's just committed a crime.
You're going to be glued to the Ryder Cup, Danny, all weekend, which is just kicking off at the moment over in Rome. We'll all be watching that. But it is very popular. It's grown a lot. Even during the pandemic, there wasn't much else to do, so people went out and played a lot of golf. It's the kind of thing that once you play it, you realise how difficult it is, and then it's more exciting to watch on TV. I mean, the statistics from the industry say around a third of Americans have at some point played or had some interest in golf. Even in terms of, there's venues like Top Golf where you can go and have a drink, so it's popular.
Well, I can tell you for nothing, I've tried it. I gave it up. I lost so many balls. I just gave it up. I never really made it past a handicap of about 15. Joe, thank you very much. We'll talk more about golf and maybe even policy with Terry Haynes, the founder of Pangea Policy, right here on Bloomberg. Countdown to shutdown. Welcome back to Bloomberg Brief. I'm Menace Crenny in New York. Danny Berger on location in Berlin, where she's been speaking to the BlackRock CEO, Larry Fink. Here's what you need to know. The clock ticks closer to a deadline. The US shutdown appears all but inevitable. Kevin McCarthy continues to struggle to get the hardline Republicans on board. The demand comes clear from the UAW. Auto workers want at least 30% pay rise from Ford, GM and Stellantis. The prospect of a resolution may help investor sentiment, and the BOJ announces an unscheduled bond buying operation after yields across the curve climbed to decades highs. Okay, so with all of that in mind, the equity market has had a pause for thought. It's as if the aggressive sell-off that you've seen across equities, the S&P heading for its biggest loss of 2023 this month, its month end, its quarter end, are they really sufficient reasons to justify a bounce of 0.5%? It's not a mega bounce, but certainly Fed peak is back in the conversation against that narrative earlier in the week that rates could get to 7%. Consumer spending was the weakest in a year. The price index was also the weakest since 2021. So that builds the narrative. Maybe there's a construct for the Fed to pause. You've got Nike at the bottom of your screen up 8%. That's what's called destocking, and they are comfortable with it. Taking inventory off the shelves, getting ready for new stocks with higher margin. Pump up your shoes, pump up the air, 8.2%. Nasdaq's up at 0.6%, as there's quite a dramatic roll down in yields. Europe is up by 0.9%. Roll it over and you'll have a look at what I mean. The yields, and Larry Fink spoke to Danny about this in terms of what's happening in the middle part of the curve at the 10 years. But look at this. We've had this drop in the 30-year bonds. 10-year bonds are rolling over globally. Look at all your bonds, UK, Germany, and the United States of America. All the yields are coming off those sort of existential highs. 30 years are in the fear stage, which is the biggest quarterly loss since June 2009. Will asset managers now be forced to sell and realize those losses? That's the next shoe to drop. The dollar is down as yields roll down, and we are in this fear stage. We will get a shutdown. Would you buy the dollar in a shutdown? Is that really where you want to be? Or is that the end of the peak dollar story? And there's intervention from the Bank of Japan. They did it today, Jen Foley says, because to do it just a couple of days ago would have been so folly and basically non-impact. The BOJ flexing its YCC credentials. Danny, good morning. You got a call from Larry Fink. He reckons rates are going to 5%, and he differentiates what we should talk about when we define recession. Good morning, Berlin.
Good morning from Berlin. Menace, it's fascinating to hear him talk about the structures in place that are going to cause a recession, that are causing this embedded inflation. Because we talk about it all the time, but he was of the opinion, look, with global supply chains, they are changing, and that's going to keep inflation high. He also talked about AI. You know, Manus, I asked him if he thought I could keep my job, and he said that both CEO and my job would go. That doesn't bring me any comfort. What's up with that?
I can't wait to see the hologram of me. You know, that's not very hopeful, is it?
Hey, as long as we can be on a beach somewhere while it's happening, then I'm okay with it. But I want to bring you more of my interview with the BlackRock chairman and CEO Larry Fink, because he also had a lot of comments on the American economy. Take a listen.
In many areas, you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, as I said, the J-curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025 the United States economy may be entering a recession, but I don't see it any time in the near term.
And part of that conversation, Manus, that Larry went on to talk about was the labor strife and the strikes, that higher wages were also feeding into this structurally different story. Now, on that point, the United Auto Workers Union said it wants a 30% raise from its strike action at Detroit's 3 major automakers. Manus, let's bring in the latest. Joining us now is Bloomberg's Oliver Crook. Oliver, first, I mean, are you intimidated? Everyone's coming for your Berlin job.
I know, this is the place to be, apparently.
He should be frightened.
Yesterday it was Wei Li. Goodness. Okay, wait, where are we on the strikes? Where are we on the negotiations?
Yeah, so listen, we've had some great reporting out of Detroit from our team there, where we have about 30% is the figure that we've got now for the increase that they want. That came down from 46%, 40%, 36%. We're now at 30%. We understand that the UAW submitted a counter proposal to Stellantis yesterday. We have not heard back, but of course, this is a deadline Friday, 10 a.m. Detroit time. We'll hear from Sean Fain. He showed up last time in camouflage, and he expanded the strike, 38 facilities. The question is, will it expand again? Will it hit 4 this time? And it's also part of a broader effort, this also out of our team in Detroit, that basically they're trying to attract non-union labor. And the question is, in the United States economy, can you have a 2-tiered manufacturing system where on the one hand you have the big 3 union labor and Tesla on the other with a much lower cost base? This is going to be front and center for the economy and the industry.
Ollie, I know that you're looking at the much bigger picture about electric vehicles, which is part of this strike narrative, but Sean Fain wants to rebuild his base. What was it, 1 million subscribers a decade ago? So for the UAW, there's a much bigger battle going on here, isn't it? It's not just about whether they support Trump or Biden. It's about expanding the base.
Exactly right. At a point when this industry is completely, the ground is moving beneath it, and we don't know where it's going to settle, and really we're in kind of the foothills of this. And as we were mentioning, you know, Tesla has something like $45 an hour as a cost base for its labor. Can you really compete with that when they're way ahead on EVs? Ford is losing $4.5 billion this year on EVs. This is really a transformational moment. So what Sean Fain wants to attract is, yes, he wants to get a living wage for these workers that are currently representing, but he wants to represent more workers, the workers that work for Tesla, the workers that work for some of the Asian automakers, and even the European automakers, which would completely rewrite the narrative of how labor works in the United States in the manufacturing sector.
Well, here's the thing. I got a WhatsApp last night. Let's bring Danny into the conversation. I got a WhatsApp last night from Martin Malone at Alpha, and he said, Gavin Newsom just put minimum wage up to $20. Japan has a wage differential that's going to blow the mind off everybody. In other words, you're going to reshore from China into Japan, friendshoring to Japan. And it's based on these much higher base salaries and minimum wages, which is good for workers and should be, treat people properly. But it is about that wage differential around the world, which drove everything to China. And now the base thesis is wages costs are now so competitive, it will be a flow show to Japan.
Yeah. I mean, are we really still going to get back to a world of 2% inflation, Manus, if this is the labor story, if we're onshoring, if we're reshoring?
We are. Listen, Danny, I presume you're on first-name terms with Larry. I just want to ask Oliver. Oliver, did you get Larry Fink's telephone number? Come on. Did you say hello? Did you meet and greet?
No, No, I did not. I focused my energy last night on the subject of AI, and we did a panel on that. But again, it's actually it's touching some of the similar themes. Can where labor is moving, the AI story.
Okay.
A lot of these people who are training the AIs are in lower cost labor markets.
Okay, Ollie, in Berlin, alongside Danny, keeping it real there. Well, the deadline is looming for this US government shutdown. That is top of our agenda. Terry Haynes is the founder of Pangea Policy. Let's get his first take on this. Terry, good to see you this morning. You say we are underpricing how long this shutdown could run for. What mistake are we making in our hypothesis as we go to this countdown clock?
The mistake, Manus, is simply that when markets hear, when investors hear shutdown, what they think is, based on past experience of the last 20 or 25 years, that it's going to be one and done. We don't know how long it's going to last, but it's days to a week, whatever. This is very different. This is a situation where Congress hasn't done any of its work on its spending bills, a bipartisan failure in my estimation. Any group that takes a 7-week vacation instead of buckling down on spending bills is to blame. So they're all to blame. But what's really happening here is that they need to start working on those, but it's going to take until Christmas to finish them. The trigger here really is defense spending and defense authorization, the how those things are spent. That will take until Christmas. What that means is they've essentially got 3 more months on every other spending bill before before they have to wrap it up. And the forcing event is that in January, according to the May budget deal, the forcing event is that if they don't have some final deal, they have to be mandatory 1% cuts in spending. So they won't want that.
Terry, let me throw another spanner in the works for you. Yeah. While you're talking about that, a story out from the Washington Post this morning saying that far-right House Republicans are plotting an attempt to remove Kevin McCarthy as House Speaker as early as next week. From what you see in D.C., 1, does that seem possible? And 2, what is that going to do to a shutdown?
Sure, it's possible, but I will say about the kind of the 20 purists that are constantly plotting against McCarthy is that that's a leverage point. They try to use that for leverage. Once they trigger that, and let's say they remove McCarthy, what then? Who's going to be Speaker? So you have a possibility of some real chaos in the House if there's no Speaker and nobody to lead the entire body, which is McCarthy's job. And that actually plays into my theory, because if you'll have a shutdown for some time, and the House will be actually unable to do a lot of its business. So that feeds into the fears of a lot of folks, I think, who are joining a flight from treasuries and are concerned about the upward trajectory of debts, deficits, and spending in the United States.
So, Terry, let's just move along. I mean, chaos is something that the bond market potentially took notice of in the sovereign rating for the United States of America. The other fact is, of course, this ongoing UAW strike. It looks like 40%. The new figure that they want is 30%. What I want to know from you is, we saw a lot of theater this week. I watched a lot of networks. Joe Biden on the picket line with the UAW. Then you had Trump speaking to the workers in that industry. What is the takeaway this week? What is Biden more frightened of? Not being seen as the workers' president, or of Trump stealing his votes in that zone?
The answer is yes, I think. Is concerned about both. Look, when you're fighting to retain parts of your political base, and unions writ large have been bedrock part of the Democratic base for almost 100 years now. When you're fighting to retain your base, you're operating from a position of political weakness. So that's what really Biden's trying to do, and Trump is trying to capitalize on the restiveness of the rank and file, many of whom voted for him, to try to peel that away. So, and in a swing state like Michigan to boot. So there's an awful lot of back and forth on the base here. But the other takeaway I would make for you is that it makes it harder for Biden to actually try to capture the center. And there's 20 to 40% of independents that may or may not vote for Biden. Makes it more difficult for him.
Terry, great to get your input this morning. Let's see what the countdown clock shows us at the close of business today, but it doesn't look that healthy. Terry Haynes, Pangea Policy Unit there with his thoughts. Coming up, we'll have a conversation now with the next CEO on Bloomberg Brief. Roy Jakobs joins the conversation on Bloomberg at 5:42 in New York. This is Bloomberg Brief. I'm Menace Rennie in New York with Danny Berger reporting from Berlin today. Joining the show is Roy Jakobs, CEO at Philips. Good to see you, Roy, this morning. We've just finished a conversation with one global leader. Let's bring it to you. No recession in the US until 2025, but prepare for more shocks. How do you see the road ahead? Is there any slowdown in your business? Good morning.
Good morning. Good to see you. Looking at the world, when I started the year, I said this is for sure not a year that is going to be business as usual, and that is actually taking effect. We do see that there are different trends in the world. The US, we do see strengthening a bit. So I think in that building on what was just said, we see some of that also back in our business segments, both in the healthcare segment as well in the consumer segment. But globally, we still see also challenges in Europe, which is slower, China, which actually is still slower. So overall, the world macroeconomically still is not in its best shape, but we do see it slightly improving in certain areas.
We're grappling with strikes from the UAW. You have many manufacturing plants in the United States of America. You're a new CEO. Set the tone for wages at Philips. Are you a supporter, an active supporter of wage revision and revising them higher? How are you going to set the tone for wages from the top at Philips?
So we are in active dialogue continuously also with our workers and also with our manufacturing facilities. So far, actually, everything is conducted in good faith, and we are running at full steam. We have also been raising wages across the globe in line with market conditions and inflation. So it's something that we have been supportive in and on, because labor is short. It's important that we keep the operation going. So we have been taking action there.
Do you still have labor shortages?
We do see certain areas where labor is short. For example, we are dialing up big time in AI and in the area of software. Of course, that is something that many more are doing. So that's an area where we are hiring and taking people from the market. We also are able to recruit, but it is a short market. So there are specific people that we are after that are in high demand, and that's where AI plays part.
So tell me, you're spending on AI briefly. What would you say your budget on AI is? Are you spending $1 billion, $2 billion in hiring in AI? What's the round figure for AI? We'll get to the recall in just a second.
Yeah, if you look to kind of our R&D spend, it's around 1.7 billion a year. Of that, more than half is actually software, and AI is an increasing part of what we do in software. So actually, AI is really taking a significant shape of that, and the application of AI is also really impactful. We're already using AI today, for example, to help to predict an event from happening when a patient is in the hospital, or to increase scanning times by 3 times by putting AI on an imaging device. Also, we are using it and looking at generative AI, how we can use it to reduce the administration time that a nurse uses per hour, average 15 minutes, to make their work easier.
Let's get to the big issue. Your stock is down by 50%. You've come in to turn this company around on the CPAP recall. I've got figures in front of me saying 5 billion euros is the right number for litigation. You've only provisioned $1 billion so far. What is your estimate, your best estimate now to the market on what this recall and litigation is going to cost you?
So the recall, of course, is very important for us, first and foremost, from a patient's perspective. We made great progress in remediating the patient's sleep. Remediation by now is nearly done. We are at 99%, so the patients are getting, the devices are getting back on therapy. That's also where we provided the 1 billion for. So that actually has been moving along with pace. The second part is we have been closing on an economic loss provision, where we provided 575 million earlier this year, Q1, and we just settled it at 479 million. So we also have been closing that out. Then there is further litigation coming.
So could
we
it get to 5 billion?
Most likely.
That's the question, Roy. How close to multiple billions is it going to be? Briefly.
We don't speculate on that number. It's too early. We are in the process of going through the investigation on that. So we have not put a number out. If we have, of course, insights around that, which we said probably is not earlier than 2024, we will bring that to the market.
What's the progress on the recall? Just remind us where you are in terms of the recall. How many have you brought back in? How many more to go?
So in essence, the sleep recall is nearly finished. We have replaced 99% of the devices in the market, which means, and that's great news for the patient, that they are back on therapy. So actually that part is really being dealt with, which also allows me to focus on the other important part of getting Philips back winning again and progressing on our performance journey, where we have seen that we have now 3 quarters of growth, and that is on very distinct actions on improving our execution, both in patient safety and quality, in supply chain, but also in simplifying the organization. So we are on a track where we're improving both growth and profitability on a quarterly tenure.
As I look at the storyboard, and I've interviewed your predecessor for 10 years, I'm introducing myself to you. I want to know who you are as a CEO. You've got a DOJ investigation, open-ended financial risk, and a reputation crisis. As those issues mount, would you support clawbacks on your predecessors if it is found that they deliberately, perhaps, withheld information? Are you a supporter of clawbacks and penalties to predecessors?
I'm focusing actually on bringing Philips back to where it belongs. And that's where I presented the plan earlier this year. That's where actually I've been relentlessly focused on improving our execution, getting momentum back. We're seeing that also coming back. We are able to provide more innovation solutions to the healthcare customers that we serve and also the consumers that we serve. The 3 progressive quarters of growth are underpinning that.
But do you think that implementing something like clawbacks would help restore the credibility and perhaps give you the opportunity to say, this is who I am? I'm going to make sure that there's some kind of accountability here. Just briefly on that, and we will move on.
So I've been taking accountability for the future of Philips at the moment I started, and that's what I focus my time on. That is resolving the recall for patients, is also working through the challenges that are tied to the litigation, but also very much focused on getting the other 18 billion of Philips to get really to true value potential. And you saw, for example, a big investor coming in, putting 3 billion into Philips because they are excited by that value creation potential that Philips has. And that's something that they see underpinned by the actions that we're executing on.
Will they take a bigger stake, and how active have your discussions been with Mr. Elkin?
So we have been actively engaged because this is not only about money, it's about building trust in each other, building trust in the trajectory. They have been taking a 15% stake. They can take up to 20%. They're putting a clear vote of confidence in, and that actually is a great subscription to what we are working towards. They also have great experience and a track record in other industries that they're in of value creation. So together we are on this path to really bring Philips back where it belongs.
We just heard from Larry Fink. He says he's underinvested in China. We hear lots of politicians telling us from the United States to Europe, which is de-risk from China. When you hear de-risk from China, what does that mean for you as a CEO? Are you preparing to decouple, retrench, friendshore from China in terms of your manufacturing?
So China is an important market for Philips. Around 15% of our revenues are in China. But what's important for us is actually that we adapt to the new situation in the world from a global supply chain perspective. And the global supply chain in the new world requires that you regionalize more. That's not only China, that is also for Europe, that is for the Americas, that is for India. So we are actually making sure that we have the right setup to serve our customers in the specific regions.
So briefly then, will you retrench from China, Roy? We're up against the clock, and I need to know, will you retrench?
We will not retrench from China. China remains an important part of the future of Philips and also how we provide services in China, but also to the rest of the world.
Roy, it's been great to catch up with you. It's always tough when you've got a big job to do, which is to restore value. We wish you well, and hopefully you and I will be talking in 10 years' time, as I did with your predecessor. Thank you for your time this morning, sir. That is the Philips CEO, Roy Jakobs, there. Let's get to Danny. She is in Berlin. Well, there you go. He's not retrenching from China, and Larry wants to do more. You're on first name terms now with Larry, are you?
Well, I think it would have been weird if I called him Mr. Fink during the conversation. I don't know. It seems a little bit too formal. Manus, that was such a fascinating conversation on many levels. But the difference of opinion one could have on China, it does come down to how you are positioned. Phillips perhaps is not in a position where they can retrench from China. BlackRock, the world's largest asset manager, perhaps is in a position where they can stay and they can wait it out. I also talked with Schwartzman last week. Same thing for Blackstone. They're also in a wait and see, and for the moment, kind of retrench on China. I
think it's interesting the way Larry differentiated, you know, this is going to be an extend and pretend situation. Well, not so much pretend, but extend. We're not going to have a recession until 2025, in his view. And it's a much stronger, it's a more muscular US economy with higher wages and people have jobs. And therefore, that plays to Goldsby's thesis yesterday, which was don't look at the historic models on how you break an economy, deflate an economy. You've got to have this massive unemployment. Goldsby warns, don't bank on the former models as the way forward.
Yeah, that's exactly what Larry Fink was talking about, the transformation of the economy. Manus, I have to go back to this line because I love it. I think you'll enjoy this too. He was talking basically about how politicians were too pessimistic, but he was hopeful. So I said, all right, so you going to run for president? Manus, his response, the response of 70-year-old Larry Fink was, I'm too young.
That is a wonder. That is music to my ears, absolute music to my ears. Himself and Jamie Dimon. So what do we see? Jamie could be president and Larry could be what? Treasury secretary. There you go. He's too young to be the president. Yeah. There's a powerful combination.
You can be chief of staff.
I can be chief of staff.
That's a great cabinet you put together.
We just need to find Jane Fraser. She can step in. We can have her at the head of the Treasury. Larry can run another part of the business, and Jamie can be president. There we go. We've solved the U.S. issues in a beat. Danny, good morning from New York.
And good morning from Berlin.